Welcome to the weekly update, where I'll go over the action in the market for the week of March 10th through the 14th, and we'll see how things look for the week of March 17th through the 21st. Another difficult week for the stock market. It was down on the week, even though we had a pretty nice little bounce on Friday. We have to ask the question, is this the beginning of something as far as a bounce and trying to go up? But if we look at all of our charts, we're still looking pretty negative. One takeaway from Friday's bounce is that it was on below average volume, and that's a technical analysis caution sign to see price go up and volume go down, where we've been above average with volume as the S&P has been going lower. So we'll go through the charts and just see what we come up with as far as a conclusion. A few things before I get started. I do post videos every day, and they're on YouTube, they're on Rumble. They're longer videos, but I'm an educator. I'm not a guru. I'm not just trying to tell people what to do. I'm actually trying to show people about technical analysis and how I reach the different conclusions that I come to. So feel free to check those out. They are available on YouTube. And I also have a daily as well as a weekly newsletter. They're free for the time being. Once I get up and going with this, all the newsletters that I put out will be $8 a month. But if you want to have access to that, just send me an email or go to the website. That's where the newsletters are actually posted. And I have a link for that here in the slide in a moment. And there's also a link right below this video. I do make a PDF available also for every video that I post. So you can look at these slides, you can look at the charts, and sometimes people find that more helpful. Here is the link to the program that I have. It's on Substack, and all you need is your email address to sign up for that. And I post all the newsletters there. Also, if you become part of the program, and it's still free for right now, you get immediate access to the videos. And as soon as the daily video is done, boom, members have access to that. The weekly video, it's already been available to the people on the website for a couple of days. I actually do two versions of the weekly video, one that goes to members because they don't need to hear all this stuff I'm telling you right now, and then this one that goes on YouTube and Rumble. I do update pivot points. They're very important, and you'll see that we've hit those a lot. There are some that last only for a day. There's some that last for the whole month. The one that we've been watching lasts for a whole quarter, and I'll point that out later on in the video. But they're updated. It's in the YouTube. I can only do this on YouTube. I can't do it on Rumble, but it's on the community tab. I do have a private Facebook group, not really active, not a lot of participation there. But if you want to change that, feel free to come on in and give it a try. And I really watch the comments that are posted both on YouTube and Rumble. Mostly they're garbage comments, but if you have a legitimate comment and you're talking directly to me or making a statement, those comments are fine, even if you disagree. But if you're asking me about some Bitcoin garbage or you're doing social media marketing and you're really a scammer looking to take people for money, I delete those right away. And then comments that just don't seem to make any sense, just a bunch of gobbledygook, I end up deleting those as well. And I do post on YouTube and Rumble. And I try to be consistent with the posting schedule. If you can't find me on one platform, feel free to jump over to the other one and see if the video is available there. Okay, let's go back and talk about the week. We were down 2.27% on. Now, for the week, we were above average with volume. Just for Friday, when we had the bounce, we were below average for that day. We are turning more negative. We're seeing some weakness here, and we're starting to develop a negative trend on the weekly charts. So, yeah, there's reason to be concerned about the market right now. But we've been at this place similar before, and we were able to bounce up out of that. The thing is, we don't really have any confirmation of that right now. And so things are still looking more negative. We were virtually unchanged as far as interest rates. We did have CPI and PPI come out last week, and they were market friendly. But with all the other stuff going on, the tariffs and the trade wars and the executive orders and Doge, and the market's kind of confused about what to do right now. And it was more negative to begin with. So even in the face of good news that they could have went up on, we saw more selling. And then we're keeping an eye on geopolitical things. What's going on between Russia, Ukraine, what's happening in Yemen with the Houthis right now, what's happening in Israel, what's the debate going back and forth between the US and Europe. There's a lot of stuff going on. Now, in the upcoming week, the Fed will meet on Wednesday. Now, they're not going to change interest rates. There's pretty much a certainty that that won't happen, but it's what do they say in their statement, in the press conference. They have a report that comes out now. We'll be looking to see if there's any hidden meaning in any of that. As far as our trend, we are beginning a trend now, and I'll show you the chart that goes through this, and it's negative because the red line is above the green line, or to say it another way, the green line's below the red line. Okay, so here are some bullet points. It was another rough week for the stock market. This has to be in the face of every investor right now, all these growth concerns. Now, this implies what's going on with the economy. Are we really slowing down? Is there going to be inflation? That's the other fear that's coming into the market. Are we starting to see things really shift and possibly go into a recession? And then all these tariff concerns. What's going on with the US and Canada, US and Mexico? Trump came out and said, I'm going to put some tariffs on Europe. Okay. And we'll have to see how all that plays out. And we did close below the 200-day moving average with the S&P 500, and it also entered into correction territory. That's 10%. When we set the all-time high back on February 19th, we've now dropped, or at least throughout the week, we dropped 10% from that closing high. Now I measure it a little bit different. I go from the intraday high to the intraday low, and we already went into correction territory that way. Now, the bounce up that we saw, we're just slightly out of correction territory right now. Then the NASDAQ, it's still in correction territory and has been for a number of days. And President Trump did say clear a week ago, and I tried to address that in last week's video, that, okay, yeah, the economy's going through a period of transition, and he didn't really give a straight answer, which is kind of strange for him. He's not a politician, he's a businessman. When asked if we're going to go into a recession, and he didn't really give an answer for that one. And then the trade wars increased after President Trump announced that there'll be a 50% tariff on Canadian steel and aluminum imports starting on Wednesday instead of what was planned, 25%, which is still seen as really high. And then Canada said, no, you can't do that, America. We're going to put a 25% tariff on exports on electricity that we're sending to the US. And in response to the originally planned 25% tariffs on Canadian imports. So, yeah, this is a trade war that's going on instead of it just being a negotiating tactic. You know, when Trump says stuff like this, he's not bluffing. He's using it as a negotiating tool, but he's willing to go that far if he has to. And you got half of America that really likes that and half of America that thinks it's terrible. Then President Trump also announced a potential 200% tariff on imports from Europe, wine, spirits. Yeah, you know, France, that's the wine capital. Italy, they have lots of wine there. That could really hurt a lot of these companies or wineries. This move was in response to the EU's recent tariffs on American whiskey. It's like, no Jack Daniels for you. Okay, and then this should be this week's inflation data was taken positive on a relative basis, but the markets didn't really react in a positive way to that. We're still above that 2% level with the Fed's target rate. And now they're worried about, okay, inflation might be all right now, but is it going to really start to spike up going forward from here? Mega caps had a difficult week. They bounced back a bit on Friday, but still, they ended up being down. And then value continues to outperform growth, and I'll show you some charts of that. And then interest rates were virtually unchanged. We were down from 4.32%. We closed at 4.31%. And the dollar was virtually unchanged, believe it or not, after just getting hammered the week previous. It was down just a little bit. Okay, so for the week, the Dow was down 3.1%, the NASDAQ down 2.4%, the S&P down 2.3%, and small caps, the Russell 2000, they keep getting hammered. They were down 1.5%. This is the inflation chart. Now, we don't know if it's really going to play out this way, But we're seeing some similarities between 1966 to 1982 with what has played out so far. And we're kind of coming down into about 1977 or so. And we're wondering, okay, is inflation going to bottom here and then start to go back up? And then look what happened back in the late 70s. And I grew up during that time, and this was hyperinflation, meaning that or actually stagflation is what they call it. You have really, really high inflation, but no economic growth. And we could go into a period like that, but we don't really know if it's actually going to play out that way. Then we are still above the 4.02% level with the 10-year yield. We're at 4.31%. And according to this research, that's when it starts biting into corporate profits. Then this was updated a week ago showing the long-term unemployed folks. It's actually going down here. And then this is just putting 2025 in perspective. Even when we have a really good year, we still have pullbacks along the way. Now, we don't know if this is going to get worse than where it's at right now, or we're going to be able to bounce up out of this. But this just shows the different years going back to 1980. And even during really solid up years, we did have declines with an average decline of around 14%, even when we have an average return of 10.3% over that same period. Then low equity risk premia. I thought that should be premium. This is when you're paid extra because stocks are seen as more risky than bonds or other kinds of investment. So you should be compensated more. Well, when you look at this chart, you're being compensated less. And it's like, okay, with the market the way it is right now, do I really want to go in and buy stocks? I'm not really getting compensated for that right now when you look at it this way. And it just compares the US in orange here to the rest of the world. Then I'm just going to go through the bottom part of this. It says broadly, all equity markets tend to fall when the US experiences a correction above 10%. Really, that just means what happens in the US tends to happen globally. Okay, then we at least at the time this chart was taken, we were down 10%. That's a correction. If we go from down 10% to 20%, once we go over 20%, that's a bear market. Now, we don't know if we're going to get there, but this has a lot of folks concerned. When we hit this 10% level, a lot of things change as far as from a money management standpoint, and folks get a little bit nervous about things. And then this is the biggest weekly slide that we've seen recently here. And this is 4 weeks we've been down now with the S&P on a weekly basis. And then what's interesting though is when we look at the FactSet blog post here, hardly anybody's talking about recession. When they do their earnings calls, they have a conference call after they come out with their earnings report and they talk about how great things are and they want to congratulate each other. And then they talk about going forward, what are they looking at on a positive side or a negative side? We're seeing not very many companies bringing up the word recession in these earnings calls, but we are seeing them talking an awful lot about AI, and that's really where it's at right now. Okay, then looking at the intraday chart, we were really going down. We had a difficult week. We gapped lower on Monday. We bounced up a little bit going into the close. And then we came down on Tuesday and then saw a nice little finish, but we gave back a lot of those gains going into the close. And then we came down on Wednesday and then we tried to bounce up out of that, but it might have been too early in the day for the smart money to do anything about it. And we just kind of fizzled and drifted sideways for the rest of the day. Thursday was the real negative day. We just kind of picked up where Wednesday left off and we just kept going down. Now we're dealing with the 200-day moving average. Now we're dealing with longer term support when we're down around this area. And it looked like maybe we were going to bounce up from that, but no, we ended up closing right down near the low. Now, the futures were strong before Friday. The consumer sentiment report came out, but we ended up gapping up here above R1. We made it all the way up to R2. We were able to hold on to those gains and actually close right at the high on Friday. So some are thinking, okay, is this the sign of some hope here? But we're going to need to see follow through with the action in the upcoming week. So for the week, and this is just the 5 trading days, we had the Dow was down, small caps were down, all the other indexes ended up being positive for the week. Not Friday to Friday, but just Monday through Friday. And then it's the NYSE that's still looking about the best year to date. All the other indexes are now down, led by the small caps being down the most. And then looking at the different sectors, since we had a down week, I sort this about what, according to what was down the most. Discretionary, that's a growth area. We want this to be doing well. It's getting hammered. Now, some of this can be attributed to Tesla because it's in this particular sector. Now, the staples, they were down, which is kind of strange because that's a defensive area. And people really start piling into that when they're getting ready for the market to go lower. Then looking at the bottom, we had utilities and energy. Now, these are usually considered to be growth or defensive areas, not growth areas, but they ended up being positive. Now, you could make a case for utilities because of the switch to AI, because of EVs, electric vehicles, because there's going to be a need for so much electricity in the future. Maybe these are growth areas, but typically, historically, utilities have been, widows and orphans. These are the safe investments that you put folks into because they pay dividends. Then we look over on the right-hand side, and this is what sector performed the best this week. Energy performed the best with a score of 81. We scale this on a score of 0 to 100. And then we had communication actually did okay, at least according to its scooter score. It was down on the week, but we want the growth areas to be up into the 90s, and we're seeing this in the low 80s. Utilities are also looking pretty good. Then if we look at near the bottom here, we have tech and discretionary. These are two growth areas, and they're coming in with really bad scores right now. They're in the 13 range. And then looking at the sectors for the 5 trading days, we had tech ended up being positive, and energy was positive, financials and utilities. All of the other sectors ended up being down, led lower by staples. Now, is that some kind of a shift? Because staples have been doing really well. And think toilet paper and toothpaste, things people have to have regardless of what's happening in the economy. And this had been an area that a lot of folks were piling into. We saw some weakness here. Are we going to see a shift back from value, that's staples, over to growth, which we get into that area for capital gains? Then going back to the beginning of the year, discretionary is still the weakest, followed by tech. We need to see this the other way around if we're going to actually turn more positive, where we have healthcare, another defensive area, because you have to have healthcare no matter what's going on in the economy, energy, a defensive area, and utilities as well. Now, some of these tend to ebb and flow with what's going on with the economy. And then looking at the performance, if you remember back to your geometry class, the upper right-hand corner is green. We have an x-axis and a y-axis, and really nothing's looking all that strong now. We had communication showing a little bit of improvement, but this goes back over the last year, not just the last week or the last month. Then we have the financials. They're doing okay, but they've been under pressure lately. And then discretionary, which had been doing well, it's yellow and it's actually showing some weakness here. And then we're seeing tech actually looking negative. And then we go through all these other areas. We're seeing some real rotation going on, some improvement, but nothing's really emerging as a leader, at least yet. This breaks it down more in a table format where we still have the financials and communication are green. Yellow, that's more neutral. That's discretionary, which is showing some weakness. Flat out negative is tech, that's red. And then all the other areas are blue, which shows that they're just improving on their chart, but they haven't really turned positive. Then we look at the different indexes. Nothing's looking all that strong right now. The thing that's holding up the best is the S&P 500 because it has growth. It has the stocks that are in the NASDAQ 100, but it also has value stocks in there as well. And so we look at the advanced decline line. It's been doing okay. And it's not that we're seeing money coming out of the stock market. We're seeing it rotating from one area to another, going from offense to defense. And that's what a lot of money managers do because they have to be invested all the time. They can't go over to the bond market. They can't fly to safety. That's why we've been seeing bonds doing well lately. People get out of the stock market and go over to the bond market. Well, if you're a mutual fund manager or if you run an ETF and your rules don't say you can do that, you can't. So what you do is you position yourself into stocks that hold up a little bit better if we are getting ready to see further declines. But we're seeing some weakness here with the OEX. That's the S&P 100, the biggest stocks that make up the S&P 500. The NASDAQ 100, that's usually the leader. and just kind of milling around here with the mid caps and small caps. We are seeing a little bit of strength in utilities and then the Dow Jones Composite Average as well. And then this is how it looks more in a table format where really the S&P is holding up about the best, and even it's been doing not so good. It's down almost 10% from its all-time high. Then the S&P 100, the NASDAQ 100, the areas that are more negative are here in red. The areas that are showing some improvement are here in blue. All right, then sentiment. This is something strange. We're at 21 as of Friday's close. But if you look at this chart, usually what happens when we look at the fear and greed index is we come down, 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 and then we capitulate, and then boom, we bounce up out of that. Come down to the 25 area, boom, bounce up out of that. Well, we've come down to 25 right now. We're just camped right here. And that's a very strange thing. You've got folks that are pessimistic and they're not getting any more positive. And instead of bouncing up out of this, they're just remaining more pessimistic about the market. All right. And then we're seeing a drawdown here with the active asset managers. They're more neutral right now. And here's another look at that reading coming in at 68.8. And then now this could be positive. Every week we get the investors intelligence, and I'm going to probably start putting this in the weekly video. I usually put it in the daily video whenever this comes out, usually during the week. It's been delayed the last couple of times, but these are people that make recommendations. You should buy this, you should sell that. And they have newsletters and websites. And then this outfit just tracks all that. Are they recommending things to buy? Are they recommending things to sell? Well, when they calculate everything, we're coming in under one. Now, are they going to stay down here for a while, like the other sentiment that we're seeing? But sometimes you can see when we come down and get a low reading, we tend to not stay here very long. Sometimes we have a little double dip here, but this could end up being positive if we use this as a contrarian indicator that everybody's negative. Okay, then that's usually the time you want to look at being positive. Then we are coming down with the VIX, but we're still above 20. And that's when we see negative annualized returns. We're going up a little bit here, where when this is positive, the black line actually goes down. That means the tech sector is outperforming cash. When this is going up, that means it's actually the cash is actually outperforming the tech sector. It'd be better just to keep the money in your pocket. And we're actually coming up into the red cloud here, the Ichimoku cloud. So yeah, this is taking a bit of a hit and not looking as positive as it has in the past. And we're also seeing some bearish signals here with the RIDEX bear bull ratio. When this goes up, that means folks get into the bearish RIDEX funds. When this is really low, that means they're in the bullish funds. And they're freaking out with everybody else. So we're getting a higher reading with this. And for 3 weeks in a row, we see individual investors extreme negative. Usually we come down here, that's a capitulation, and everybody's freaked out. We bottom and then we start going up. Well, they've been camped down here for 3 weeks now. And that's an unusual thing to see. And let's see, this is an old, actually, this is a look at I hit the wrong button. I'm sorry about that. Looking at the ulcer index here, we're actually starting to come above the moving average here. And this is another sentiment gauge. And it shows that fear is going up. We're getting a high reading on the daily chart too. And then we're also seeing a little bit of a concern here. This is the spread between risky bonds, like junk bonds, and not as risky bonds, government bonds. When this really starts to go up, that means there's an increase in fear in the bond market. And that's what we're seeing here. Now I inverted it on this particular scale here to match up with the S&P, and I inverted the VIX here. This is actually a chart that I got the idea from David Keller, who is with stockcharts.com. But when this is going down, that means there's an increase in fear. And if this keeps going down, that's going to be a concern to the market. We look at the VIX and then a 3-month average of the VIX. That just shows that the shorter term VIX is outperforming the 3-month average of the VIX. And that just tells us that fear is going up. And we're not doing that bad here with the 253 period equity put call ratio. Now, there are 253 trading days in a year typically. And we're leveling out where we had been declining. This is positive when we're going down. Now, we could turn and start to go back up. That would be more negative. Or we could just chop around here for a while. When we see this chart being the most helpful is like in 2022, this chart just kept going up and up and up and up and up. And then since we bottomed and are starting to go up, we see this chart going down, 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 down. That means there's less hedging going on longer term. Looking at the economy, the national financial conditions, we're still under the black line. That means everything's fine according to this chart. This is another thing that freaked the markets out about a month ago. Right about the middle of February was everything when everything started to go nuts. Well, one of the things that came out was a negative GDP forecast by the Atlanta Fed, and they're still down here. They're even below 2%. Okay, but I wish these guys would email each other, because if they would just talk to the New York Fed, they're still coming in with a positive forecast. So take your pick on which one you're going to choose there. This is the Atlanta Fed GDP now, showing that we could potentially see negative GDP for the first quarter of 2025. This hasn't been updated for a week. It's actually coming down after going above this red line. That's positive for the market. The employment situation is doing okay. Jobless claims actually went down this week. And that's one of the areas that we'll be watching to see if we end up going into a recession. And this is still doing okay. The smooth US recession probabilities. We get concerned if we go above the black line. We get really concerned if we go above the red line. We're way down here still with this. And this is a quarterly update here. The leading index is actually coming down. Other times when this really started to go up, that's when we went into a recession. The fact that this is coming down is more encouraging. As far as inflation, we did get PPI and CPI this past week, so they adjusted throughout the week, but we're not seeing any real big changes. Each one of these little circles, it's for every day. So this updates each day. Now, there's a 98% chance that when the Fed meets on the 19th, they're going to leave rates exactly where they are at 4.25 to 4.5. And that's where they're at now. And the market's pretty much rolled over and given up to the idea that they're either going to cut rates or raise rates, that they're going to keep rates paused. And that's pretty much what the Fed has said. Now we start looking out to the May 7th meeting. There's almost a 72% chance as of right now that they'll keep rates the same at that meeting as well. And seeing a little bit of moving around here, but the market's kind of getting to the point of accepting that. And looking at the balance sheet, since June of 2022, it has been going down. This little blip up, this is when Silicon Valley Bank went out, when they went crazy. And then we had Republic Bank, and then not long after that was New York Community Bank. That's when we saw this little spike up. But for the most part, the Fed balance sheet has been going down. And this looks at it on a year-over-year basis, which just amazes me because the number's actually negative, which you can't see, but you show a negative number, but it's actually going up. Only a government chart can do that. And then we keep an eye on this. Nothing looking too crazy right now. This is the overnight reverse repurchase agreements. If this really starts to spike and go crazy, that means the banks could be having some problems, and we're not really seeing anything right now. Okay, here is the advanced decline line, the weekly chart. We're still above the moving average based on price and volume, even though we turned down a bit here. But this seems to be holding up, as it looks like there's rotation going on in the market rather than money coming out of the market. And then we look at another chart, and now this kind of disagrees with what I just showed you. This is the 52-week market breadth. And we're actually coming down. We're not down to this -1 standard deviation yet, but this is showing that things are more negative. If we were above this blue dashed line, that would be more positive. And then we look at the new highs, new lows. Not an awful lot of change here. So we're going down with the 4-week and the 10-week moving average. And we're actually looking more positive here. We're above zero and going up with the advanced decline ratio, 19-week, which is blue, and the 39-week, which is red. And this is where we're looking more negative now. We're starting a trend. We crossed above the moving average, and it's negative because the red line is above the green line. Now, it won't officially be a trend until we go above 20, but I put the moving average on here. That just shows that things are getting stronger. And because the red line's above the green line, that means it's a negative trend. And we saw a real drop off here with the Arun after it had been positive for quite a while. This tries to measure the buyers in green and the sellers in red. you can see the sellers just really spiked up here, and that caused the oscillator to actually go negative. And we're seeing a potential trigger on the daily chart for the mass index. We're not getting one here. And we'll be keeping an eye on that. This tries to suggest that there will be a reversal, and we have to go above the dash line, the red dash line, above the blue line, and then come back down to the red dash line. Whatever is happening at that point, the mass index suggests that there'll be a reversal from that. So far on the daily side, we've gone above the red dash line and the blue line, but we haven't come back down yet. All right, then looking at the daily chart, you can see where we're underneath the 200-day moving average. And then in Friday's action, we were below average with volume. And I think this is kind of important here. This is a trend channel going back to 2009. We hit the upper end of this when we hit the all-time high in early December. And that's when things really started to slow down. And we've just seen this real loss of momentum in the market. And now we're finally starting to roll over and actually go down. This is, to me, probably the most important chart right now. This is a weekly chart. And this shows pivot points. Now, the cool thing about pivot points is that we can see them before they happen. And we actually came down and fell below this pivot point earlier in the week, but we had enough of an up move on Friday to get us back above this pivot point. So for right now, that's positive. If we lose this, that's going to turn things more negative. Just to give you an idea of how important these pivot points can be. When we were really screaming up in 2021, we hit this pivot point and then boom, we reversed and went into 2022, which was a cyclical bear market. Then we finally started coming up out of this. We hit another one of these long-term pivot points, and then we went into almost a 10% correction. And then we finally came up, broke above that. And then this is the end of the world day here. Last summer, when we felt, we came right down to this pivot point and then bounced up off of that. Now, this is a little bit more negative in the fact that we've already dropped below this on an intra-week basis. So that's a little, these other times, we just touched that and turned and went the other way, no matter what day of the week it was. The fact that we are a little bit below it, that might suggest there could be some weakness. But for right now, this support level is holding because we closed the week out above this pivot point. All right, now we're taking a hit here, but we're still looking okay with the 50-week moving average for the S&P. We're dropping below the 13-week. We've already been below that. Now we're dropping below the 50-week, which equates to a 200-day moving average. And you can see the S&P's getting hit here, but we're not too far away from that 50-week moving average. And I took the other indicator out of this. It's called the boom indicator. It tries to measure the distance from the indicator to the moving average. And it's all crazy right now. So I just dropped that. But we're still above the moving average here. This is a smart money indicator. If we were turning more negative, we would be dropping below the red line. We're not. We're still above it. And we're actually positive after Friday over on the daily side. Now, that doesn't necessarily mean the market's going to go up. It just means the smart money is in there buying. Now, are they buying growth or are they buying value? That's what's been holding this up for the most part. They're selling growth, but going back in and buying value. Then this is negative, though. This is our second smart money indicator, the chicken money flow. The histogram is going down. The red line's going down. We've actually turned negative on the daily side and have dropped below zero. And we're positive with this chart on the daily side, but we're kind of sideways to negative here with the chicken oscillator weekly chart. It's declining. This is smart money indicator number 3. The vortex is turned negative. We see the red line going above the green line and the green line's going down. So that's negative there. We're dropping below zero here with the McClellan oscillator. We're coming down to the midpoint here with the summation index based on price, and we've already dropped below it here based on volume. That's turning more negative. The bullish percent index also looking more negative. We want this to be above 50 and going up to be positive. It's declining below 50. And then we look at the swollen trading oscillator below zero based on price and declining. We were flat here. We turned up just a little bit based on volume, but we're still below zero. And then we look at momentum, which has been negative now for a while. We're rolling over with the PMO. We're below zero based on price and volume. And we're declining with all the PMOs inside of the S&P 500. Well, all of those stocks, we see that the percent of PMOs are actually going down. And then the buy signals are also decreasing, and the PMOs that are above zero is also declining as well. And then this is interesting, and this could end up being positive. We closed below the lower Bollinger Band, even with Friday's bounce. Now, you can see other times when we had extreme negative readings, sometimes this meant really good things going forward. Is that going to mean something this time? Now, how this gets worked off is we go up in price, or the Bollinger Band keeps coming down, or a combination of the two, but we tend to not stay here for very long. So this could end up being positive, but right now it's pretty negative. Okay, then we're on a looking at a negative readings across the board. When we look at our short, intermediate, and long-term oscillators, everything is going down. Copy curve, another momentum oscillator, also going down, and we're still going down on the daily side. We're negative with the force index, also negative on the daily chart. Below 50 with the money flow, also negative on the daily side. The rate of change, we were below zero here because we had a down week from the previous week, but it wasn't down quite as much as we saw last week. But when we look at the rate of change over 50 weeks, we're going down. We're seeing longer term deterioration right now. The Stochc RSI is extreme now, but it can stay down here for a while. If we keep falling, you can see there are extended periods of time when this gives an extreme negative reading. And we're starting to come down to an extreme negative reading with the Williams percent R. And this is something that hasn't happened for quite a while, going back to 2023. We're dropping below 50 with the long-term RSI based on 14 weeks. And we're just a little bit below 50 now with the ultimate oscillator. That's turning more negative. Now, on the daily side, we've dropped below the red line with the special K. We're still positive here, but it's starting to roll over a little bit. Then we're dropping below this 40-week moving average. We're losing some pretty significant support. If we keep falling, I'll come in here and redraw these Fibonacci retracement levels. It's just we're still kind of a far ways away from those. This green line, this is a 200-week moving average, and this is where we finally bottomed back in 2022. That was a level, we broke that for a while, but it held and we were able to come up out of that. Okay, then as far as the trend though, on the weekly charts, excuse me, I have to keep clearing my voice here, and I do all these videos take one. All right, we're negative with the Heiken Ashi. We're negative with the red line pointing down with the Kegi chart. We just rolled over and they're looking negative with the Renko chart, and we're negative with the three-line break chart. And we went down enough to draw some more O's in. That's negative. When we're going up, X's go in here. When we're going down, we're seeing more O's. We're still working off of a double bottom breakdown. That's when we broke below this level here that was generated back on February 24th. And then we're going down more with the ease of movement. That means the path of least resistance right now over the last 14 weeks is now negative. And we're seeing momentum dropping off. In the long term, we're going negative here in the intermediate term, and we're also negative in the short term. And we're negative with the Elder's Impulse system with the red bar. We've seen 3 red bars for the last 3 weeks. We're negative with the parabolic SAR. We're also negative on the daily side since the dots are on top. And then, but you look at this, we haven't really seen any changes here. On the daily side, we are negative in the short and intermediate term with all the different stock indexes. They're still positive in the long term. And then we look at the different markets where bonds are still positive in the short and intermediate term. Commodities are negative in the short term, and the dollar is negative in the short and intermediate term. And we're seeing a breakdown here. I just look at the indexes themselves, the S&P coming down, the mid caps coming down, small caps coming down and showing even more weakness. But you can see here where all of the indexes closed up off of the lows. So we'll see if that turns into something positive. And the Dow, it's dealing with its 50-week moving average here. It's actually underneath its 200-day moving average. And the NASDAQ is underneath its long-term moving average now. The NASDAQ 100 almost back up here. You can see where we opened, came down, and closed near the high for the week, even though it was still down. Maybe something good is starting to develop, but we're not seeing much confirmation in our charts yet. The mid caps just continue to look weak, and we're in danger of seeing a death cross here if the blue line crosses down below the red line. Small caps looking even weaker and almost closer to a death cross there. The NYSE still above its 50-week moving average. It's holding up a little bit better, but there's value in that index. It's not just growth, it's growth and value. That's why the S&P's been holding up a little bit better too, but even it's been getting hit. The Wilshire, this is a daily chart underneath its 200-day moving average. All stocks, now we're seeing more strength in world stocks right now than we are in US stocks, and that's why we're taking a bit of a hit here. The FANG index actually came right back up to its 50-week moving average, which is the 200-day moving average, and we closed right there on Friday. These are the really big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. Is this the beginning of something, or just a little bit of a pause before we get ready to see more declines? ARK was down over 6% and falling underneath its long-term moving average. We're keeping an eye on the banks. They've been getting hit with everything else now, negative on a momentum basis up here on the top, and also going down with the MACD on the bottom. And I'm going to just look at the Dow, which is holding up better. It's actually the best looking index right now because it's the least negative. Not that it's the most positive. Transport's just getting hit these days, and utilities have been holding up a little bit better. And then March tends to be okay. Going back to 2021, we've been up 80% of the time with a return of 1.8%. Tell that to the first half of March. It's just not playing out that way. Then looking at commodities, and this going up is what's causing some inflation concerns. These are things like energy, agricultural things, precious metals, industrial metals. As a whole, they're all going up right now, and that could be inflationary. But oil's been going down. So, but that can also be attached to geopolitical events as well. The dollar was virtually unchanged, but down slightly. It's still in a longer term uptrend, but just getting hit. Just a week or so ago, it was in the 107 range. Now it's in the 103 range. But this is actually encouraging, both on the daily side and here on the weekly side. Copper is in an uptrend, and this is often used as a barometer of the economy. If copper's going up, that means this market anyway is anticipating that the economy is going to be doing good into the future. So you can take a little bit of brightness from that. Gold set an all-time high on Friday. Silver not at an all-time high, but is also in an uptrend. We're still going up with the price of bonds when we look at the total bond ETF. And we're taking a bit of a hit here. We're coming back down to the moving average for the first time since about 2021 or so. Even when we went through the bear market, stocks were still outperforming bonds. Now we're coming back down here to this 10-week moving average. Actually, 10-month, I'm sorry. And we look at how interest rates have been coming down. This is a daily chart, but lately they've been bouncing back up a little bit. This is a weekly chart, watching the 10-year yield in Japan, but it doesn't seem to matter because the rest of the world has plenty of other things to freak out about right now. And then looking at all the markets together, gold has been doing the best year to date, followed by bonds based on price. Then we have the dollar. Now, everything below this line is negative. The dollar's down the least. Then we have oil. Then in last place right now are stocks. Then we look at a ratio between the NASDAQ 100 and the S&P. This is coming down because the S&P has been holding up better than the NASDAQ 100. In a good growth environment, this ratio would be going up. And the S&P 100 pulling back against the S&P 500, but longer term still in an uptrend. Growth to value. We want growth to be outperforming. It's been getting hit hard here. Now we could bounce back up and we could show some improvement, but it's really been getting hit hard lately. Gold, and it's not, well, gold has been going up, but since stocks have been going down, that's where we're seeing this ratio just skyrocket up here. And then the dollar's been going down and gold's been going up. So we're seeing this ratio going up as well. Now, this is another thing that hasn't happened in a while. We're seeing bonds slowly start to outperform stocks. Now, not enough to change the trend, but if this keeps going up, that means the market's getting more defensive and that stocks are underperforming. But we're still in a downtrend with this longer term. And we look at low volatility stocks, compare them to the S&P. For all of 2023 and most of 2024, this was going down. Now it's starting to go back up. That means the market has been getting more defensive. Discretionary versus staples, still in an uptrend, but really getting hammered lately. And then energy has been underperforming tech, but lately it's been outperforming. And we're seeing are these shifts going to mean something? We've seen these shifts before and then they came back. Is this really going to turn into a shift where we see an overall change in trend with this ratio? And then we look at small caps, which have been getting hammered, and the tech sector, which has been getting hammered. And so we're just kind of going sideways now with this weekly ratio. Longer term, nothing all that positive right now with the NYC breadth thrust or the swag NYC breadth thrust. We're seeing some weakness coming in here, but we're seeing weakness pretty much everywhere except gold right now. And this is a long-term chart going back to 1987 of the weekly version of the S&P. We're coming down, but we're still above this trend line. This is a further blow up of that same chart. If we keep coming down, I'll extend this line out here. We're still on a full-on Zohorchak buy signal. Now that could change at any time, but this hasn't changed yet. And then we are seeing a little bit more weakness with the NASDAQ 100. This is a trend line going back to 2009. We're falling even further below that. We're seeing some weakness, but still above zero. When we look at a 50-period moving average of the new highs and new lows inside of the S&P, and then we're also dropping below zero with the NYSE new highs minus new lows. This is still holding up though. When we look at the NASDAQ 100 to Dow ratio, this is supposed to be growth to value. Well, there's Nvidia's in the Dow now and Microsoft's in the Dow, so it's not all value. But this is holding up okay. We're above this red line. And then we compare the NASDAQ 100 to small caps, and it's not that the NASDAQ 100 has been doing well, it's that the small caps are doing terrible. And so that's keeping this ratio up pretty high currently. And we want to keep an eye on the 3-month yield, but it's pretty much going sideways for the last, well, start of 2025. And then we're seeing a little bit of weakness here with the cumulative new highs, new lows on the NASDAQ after it had been showing signs of an improving nature there. Seasonality, we tend to be positive 60%, 65% of the time in March, and we're up 1%. Tell that to the first half of March. And then November through April is the most positive time for stocks. We're up 77% of the time with a return of 7.1%. And then here, the second half of March, we'll see if it does any better than the first half of March, which is the second best performing period of the year going back to 1950. And then the first quarter tends to be kind of a rough one. We're going to be finishing out the quarter at the end of March after an election. This is a composite here where they take a 1 year, 4 year, and 10 year cycle and cram them all together. I actually showed this chart a week ago. We're down here now. I mean, we're way down here as far as this dashed line with what's been happening. Well, maybe we'll get through this little rough period of time and then things have a chance of turning a little more positive. We'll see. And then, according to Carson, the second half of March tends to be a little bit better than the first half. But that goes against some other seasonal research we've seen. Now, we do have a Hindenburg Ullmann. And if you don't know what that is here, this is the 3 criteria for all of that. Pause the video and read through this. Now, what has to happen, though, is we've only seen one spike. And between now and March 31st, we have to see another spike or this spike goes away. It has to be confirmed. It has not been confirmed yet. Now, other times when this got confirmed, this was right before the COVID crash, boom. And this was right at the end of 2021, going into the bear market of 2022. So we're going to wait and see. If we get another spike up here, I also update this on the daily video side. So feel free to check back in and see if this changes. So thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.